Welcome to this tutorial on RAROC, Risk-Adjusted Return on Capital, a fundamental concept in the FRM curriculum and a widely used metric in modern banking risk management. RAROC is more than just a formula. It's a decision-making framework that banks use every day to evaluate whether they are being adequately compensated for the risk they take and the capital they deploy. In this presentation, we will build your understanding from the ground up what RAROC is, why it matters, how to calculate it, and how banks use it in practice to make better capital allocation and pricing decisions. Let's get started. So, what is RAROC exactly? RAROC is a performance and capital allocation metric used by banks to assess whether the return generated by a business activity, transaction, portfolio, or customer relationship is sufficient relative to the risk taken and the capital consumed. At its core, RAROC answers a simple but powerful question. After adjusting for expected losses and measuring the economic capital required for unexpected losses, is this activity really creating value for the bank? This adjustment is critical. It puts different activities, regardless of their risk profile, on a comparable footing. A low-risk government bond portfolio and a high-risk corporate loan book might both generate profit, but RAROC tells you which one is using capital more efficiently. Without RAROC, banks would struggle to compare apples with oranges. With it, they can make disciplined, risk-aware decisions across the entire organization. Why do banks need RAROC? Because profit alone is not enough. Consider two activities. A government bond portfolio generates modest income with low risk. A leveraged corporate lending book generates higher income but consumes far more capital to support the credit risk. If you only look at nominal profit or accounting return on equity, these two activities might appear equally attractive. But that comparison ignores the fundamental differences and risk. RAROC solves this problem by explicitly adjusting for risk and scaling the return by the capital needed to support that risk. It tells you per unit of capital at risk which activity is delivering superior performance. This is why RAROC is central to modern banking. It ensures that risk is priced correctly, that capital is allocated efficiently, and that shareholders are compensated for the risks the bank is taking on their behalf. RAROC is not just a theoretical concept. It is a practical tool embedded in daily banking operations. Banks use RAROC for pricing loans and credit facilities. If a proposed loan doesn't meet the bank's required RAROC hurdle, it may be repriced or totally declined. They use it for evaluating business lines, which divisions are creating value on a risk-adjusted basis, which are consuming capital inefficiently. So RAROC enables comparing portfolios across different asset classes, geographies, and customer segments. It answers the question, where should we deploy the next dollar of capital? And it supports approving transactions. Before extending credit or entering a derivative contract, the bank checks, does this meet our RAROC threshold? In all these applications, RAROC provides a common language for decision making, a language that explicitly incorporates risk. To understand RAROC, you need to grasp the distinction between expected loss and unexpected loss. This is foundational. Expected loss is the average loss a bank expects to incur over time from normal business activity. That's ordinary credit defaults, for example. Expected loss is treated as a cost of doing business. It should be covered by pricing, provisions, reserves, or margins. You price it into your interest rate or your fee structure. Unexpected loss, on the other hand, is the additional loss that may arise in adverse but plausible conditions. or scenarios beyond the expected average. Unexpected loss is what economic capital is meant to absorb. It is the buffer that protects the bank's solvency when things go wrong. RAROC is built on this distinction. The numerator adjusts for expected loss. That's removing it from the return calculation because it's predictable cost. The denominator measures the capital held for unexpected loss. So RAROC is really asking, after covering the routine expected losses, how much value are we earning relative to the capital we are holding for the bad scenarios? And this two-layer framework is what makes RAROC more informative than raw return metrics like return on equity or simple profit margins. Let's formalize this with a standard RAROC formula. At the highest level, RAROC equals risk-adjusted net income divided by economic capital. Now, what do we mean by risk-adjusted net income? The expanded formula shows the full picture. Revenues minus funding cost minus operating cost minus expected loss, and in some cases minus taxes, all divided by economic capital. Let me break this down component by component. Revenue includes interest income, fees, trading income, and whatever the activity generates. Funding cost is the bank's internal cost of funds used to support the assets. Money banks use transfer pricing framework to assign this cost. Operating cost captures the share of expenses attributable to the activities such as staff, servicing, technology, overhead, and many others. Expected loss is the anticipated credit loss after calculating as PD times LGD times EAD. We will unpack this concept shortly. The result after subtracting all these costs and expected loss is your risk-adjusted net income. Dividing that by economic capital, the capital the banks estimate it needs to absorb unexpected loss at a chosen confidence level, and you have then the RAROC. This formula is more than arithmetic, so it's a complete framework for thinking about risk, return, and capital efficiency. Let's zoom in on the numerator of the RAROC formula. The components that make up risk-adjusted net income. Revenue depends on activity. For a loan, this includes contractual interest income, arrangement fees, commitment fees, and any cross-selling revenues that bank chooses to allocate. For a trading desk, it might include mark-to-market gains and fee income. Funding cost is bank's internal cost of fund. If the bank borrows at 3% to fund a loan yielding 7%, the funding cost is that 3%. Many banks use sophisticated fund transfer pricing system FTP to assign funding costs dynamically based on terms, currencies, and liquidity. Operating cost includes the share of expenses directly and indirectly attributable to the activity, such as staff compensation, servicing costs, credit administration, technology, and unallocated overhead. Expected loss is a critical adjustment. For credit portfolios, this is typically calculated using the formula we are about to see. That's probability of default times loss given default times exposure at default. After you subtract all these costs, such as funding, operating, and expected loss, you arrive at the risk-adjusted net income. This is the return after accounting for the routine, predictable costs of doing business. It's what's left to compensate shareholders for the capital at risk. Expected loss is calculated using a simple but powerful formula. EL equals to PD times LGD times EAD. Let me define each term. First, PD, probability of default, is the likelihood that a borrower will default over a given time horizon, typically 1 year. For example, a PD of 2% means there is a 2% chance the borrower defaults in the next year. LGD, loss given default, is the proportion of the exposure you expect to lose if default actually occurs, after, of course, recoveries. An LGD of 40% means that if the borrower defaults, you expect to lose 40% of the exposure after accounting for collateral, guarantees, and recovery efforts. EAD, exposure at default, is the amount outstanding at the time of default. For a term loan, for example, this is typically the drawn balance. For a revolving credit facility, it might include an estimate of how much will be drawn down at the point of default. Multiply these all together and you get the expected loss, the average amount the bank expects to lose on the exposure over the time horizon. This expected loss is then subtracted from the revenue in the numerator because it is predictable and recurring cost that should be priced into the transaction. Let's walk through a concrete example to make this tangible. Suppose you have a loan exposure with the following parameters. PD equals 2% means a 2% probability the borrower default in the next year. LGD 40%, it means if default occurs, you lose 40% of the exposure. EAD equals 10 million euros. That's the outstanding exposure. Now applying the formula, expected loss EL is equal to 2% or 0.02 times 40% or 0.40 times 10 million, that gives 80,000 euros. This means that on average you expect to lose 80,000 euros per year from this exposure due to ordinary credit risk. This 80,000 euro is not a surprise. It's a predictable cost of being in the lending business. When you calculate RAROC, you subtract this 80,000 euros from your revenue. Why? Because you need to see what return is left after covering the routine expected credit cost. Only that residual return compensates you for the capital you are holding to absorb the unexpected losses, the tail events that are worse than average. Now let's turn to the denominator of the RAROC formula, economic capital. Economic capital is the capital the bank estimates it needs to absorb unexpected losses at a chosen confidence level, typically something like 99.9% over a given time horizon, usually 1 year. Think of it this way. Expected loss is the average. Economic capital is the buffer you need to survive the tail events. That's the scenarios that are worse than the average but still plausible. How do banks estimate economic capital? They build models based on credit risk models that simulate default and loss distribution, market risk models like value at risk or expected shortfall, operational risk models that quantify operational failures and losses, and diversification adjustments that recognize that not all risks move together. We also call it diversification benefit, which is derived from the correlation between different assets and different positions. Here is the critical point. Economic capital is not the same as regulatory capital or accounting capital. Regulatory capital is set by Basel standards. Accounting equity or accounting capital is what appears on the balance sheet. Economic capital is an internal risk measure. That's the bank's own estimate of how much capital it truly needs to remain solvent under severe stress. This distinction is important for the exam. Economic capital is forward-looking, risk-sensitive, and model-based. It is the right denominator for RAROC because it measures the capital actually at risk. Let's walk through a complete RAROC calculation step by step. I will split this into 2 slides so we can go slowly and make sure every step is clear. Suppose a bank is evaluating a 10 million euro loan with a 7% annual interest or yield. And step 1, we estimate gross revenue. A loan of 10 million with 7% interest rate, we get a gross revenue of 10 million by 7% equal to 700,000 euro. And step 2, we deduct funding cost. Assume the bank's internal funding transfer pricing assigns a 3% cost of fund. That gives funding cost of 10 million by 3% equal to 300,000 euros. And step 3, calculating net interest spread. Revenue minus funding cost. That's 700,000 minus 300,000 gives us 400,000 euros. This is our net interest income. Step 4, deduct operating cost. Assume allocated operating expenses such as staff, servicing, systems, all together total 50,000 euros. So 400,000 minus 50,000 equals 350,000 euros. At this point, we have 350,000 euros before adjusting for expected loss. Let's continue on the next slide. Continuing from the previous slide, we have 350,000 euros after deducting operating cost. And step 5, we deduct expected loss. We calculated earlier that expected loss for this loan, given a PD of 2%, LGD of 40%, and EAD of 10 million, gives us 80,000 euros. So in step 6, we reach to our risk-adjusted net income by deducting 80,000 from the amount 350,000, which equals 270,000 euros. This is our risk-adjusted net income. And step 7, we estimate economic capital. Suppose the bank's internal credit risk model estimates that the economic capital required to support this exposure at 99.9% confidence level is 1.5 million euros. After calculating all parameters, we now calculate RAROC. That's dividing risk-adjusted net income by economic capital. So 270,000 divided by 1.5 million gives us 0.18, which is 18%. So the transaction RAROC is 18%. What does this mean? It means that for every euro of capital the bank ties to support the unexpected loss risk of this loan, the bank is earning 18 cents of risk-adjusted return per year. The question is 18% a good amount? That depends on the bank's hurdle rate, which we will discuss next. RAROC by itself does not tell you whether to accept or reject a transaction. You need a benchmark called hurdle rate. The hurdle rate is the minimum RAROC the bank requires to create value for shareholders. It's typically tied to the bank's cost of equity. Its target shareholder return or internal capital charges also important aspects to consider. Suppose the bank's hurdle rate is 13%. If the transaction's RAROC is 18%, as in our example, then 18% exceeds 13%, so the transaction creates a value. It earns more than the minimum required return on capital at risk. Then the bank should accept it. But if the transaction's RAROC were only 9%, then 9% is less than 13%. The transaction destroys value on a risk-adjusted basis. Even if accounting profit is positive, the return does not justify the risk and capital assumed. The bank should reject it or reprice it. This is the power of RAROC. It provides a clear, objective decision rule. Accept if RAROC exceeds the hurdle rate, reject if it does not. This discipline ensures that the bank does not waste scarce capital on activities that don't compensate shareholders adequately for the risks taken. Let's go through a more realistic, detailed example to reinforce the full RAROC calculation. A bank grants 50 million euro term loan with the following assumptions. Loan yield 6.5%, generating interest income of 3.25 million euros, annual fees 0.3%, generating 150,000 euros, total revenue is 3.4 million. Now deducting the cost. Funding cost at 3.2% or 1.6 million euro gives us 1.8 million. Then we deduct operating cost of 200,000, which remains 1.6 million revenues, And after that, we are extracting expected loss of 262,500 euros. All these gives us a risk-adjusted net income of 1.3375 million euros. So the economic capital required 5 million euros. In this case, Raruk is 1.3375 million divided by 5 million economic capital equals to 26.75%. So this loan delivers a RAROC of 26.7%. If the bank's hurdle rate is 14%, this transaction is highly attractive. It delivers nearly double the required return on capital. The bank should absolutely pursue this relationship. It's important to distinguish RAROC from traditional return metrics like return on equity, or also called ROE. ROE is calculated as net income divided by accounting equity. It is a simple, widely used measure of profitability. But ROE has a critical flaw. It may ignore risk differences. Two business units might have the same return on equity, say 15%, but one might be generating that return from low risk government bonds, while the other is generating it from high risk leveraged loans. So return on equity treats them as equivalent, even though the risk profile are vastly different. RAROC, on the other hand, explicitly adjusts for risk. The numerator removes expected loss, forcing you to recognize predictable credit costs. The denominator scales by economic capital, forcing you to account for the capital needed to absorb unexpected losses. This makes RAROC far more suitable for internal risk-based decisions making. It ensures that you are not fooled by high nominal return that come with disproportionately high risk. For the FRM exam and for practical banking, remember this, that return on equity is an external accounting-based measure. RAROC is an internal risk-adjusted measure. So RAROC is what sophisticated banks use to allocate capital and evaluate performance. Let's discuss the key advantages of RAROC, why it's become such a central tool in modern banking. First, RAROC links profitability to risk. It ensures that you cannot claim success just because accounting profit is high. You have to earn enough to justify the risk and capital consumed. Second, it improves capital allocation across business units. Without RAROC, capital allocation can be political or based on historical momentum. RAROC provides an objective, quantitative basis for deciding which business unit deserves more capital and which should be scaled back. Third, it supports risk-based pricing. If you know your target RAROC and your economic capital, you can reverse engineer the minimum revenue you need to charge. This ensures you are not underpricing risk. Fourth, it enables comparison of heterogeneous businesses. You can compare a corporate lending book, a trading desk, a retail mortgage portfolio, and a project finance team, all of the same RAROC basis. They speak the same language. These advantages are why RAROC is not just a metric, it is a management philosophy. It aligns incentives, supports strategic planning, and ensures that risk and return are always considered together. Of course, RAROC is not perfect. It has important limitations and you need to be aware of them, especially for the FRM exam. First, model risk. Economic capital depends on internal models, credit risk models, market risk models, operational risk models, and others. If those models are wrong, your RAROC calculation is wrong. That's garbage in, garbage out. Second, sensitivity to assumptions. RAROC can change materially depending on your assumptions about PD, LGD, and correlation. Confidence level and time horizon are also important factors. Small changes in assumptions can lead to large changes in economic capital and therefore in RAROC. Third, allocation challenges. Allocating economic capital across business units is difficult. especially when diversification effects exist. If two units' risk are not perfectly correlated, the total capital is less than the sum of stand-alone capitals. How do you allocate the diversification benefits? There is no perfect answer. Fourth, gaming potential. If business units are evaluated on RAROC, they have an incentive to game the system. That's by pushing down allocated capital, underestimating expected loss, or emphasizing short-term revenue. This is an agency problem. Fifth, regulatory versus economic capital. A transaction with excellent RAROC may still be attractive from a better regulatory capital perspective, and vice versa. RAROC optimizes internal capital efficiency, but regulatory capital is what you are actually required to hold. These limitations don't invalidate RAROC. They just mean you need to use it carefully with robust governance and understanding of the underlying models and assumptions. One of the most practical applications of RAROC is loan pricing. Let me show you how it works. Suppose the bank has a target RAROC of 15% and the economic capital required for a particular loan is 2 million euros. If RAROC equals risk-adjusted profit divided by economic capital, then you can rearrange to solve for the required risk-adjusted profit. Required risk-adjusted profit equals target RAROC times economic capital. So 0.15 times 2 million equals 300,000 euros. This is the risk-adjusted profit you need to earn. Now add back the costs that were subtracted in the numerator. Operating cost 70,000 euros, expected loss 90,000 euros, funding cost 400,000 euros. Total required revenue is 300,000 plus 70,000 plus 90,000 plus 400,000 equals 860,000 euros. So the loan must generate at least 860,000 euros in annual revenue to meet the 15% target RAROC. This is how RAROC supports risk-based pricing. You know exactly how much to charge to compensate for the risk, cover cost, and achieve your return target. It removes guesswork from pricing decisions. Let's crystallize the core conceptual takeaway for the FRM exam. Expected loss is priced or provisioned. It's a predictable, recurring cost of doing business. You cover it through your interest margin, your fees, your loss reserves, or any other parameters. It's built into the economics of transactions. Unexpected loss is covered by economic capital. That's the buffer you hold to absorb tail events. The scenarios that are worse than average but still plausible. Economic capital protects your solvency. RAROC measures the return you earn after adjusting for expected loss, scaled by the capital you hold for unexpected loss. This two-layer framework, expected loss in the numerator and expected loss in the denominator, is the essence of RAROC. A high RAROC means you are earning a strong return relative to the capital needed for the risk. You are using capital efficiently. A low RAROC means the activity may be profitable in accounting terms, but it is inefficient in risk-adjusted capital terms, so you are not being adequately compensated. This distinction is absolutely central to the FRM curriculum and to modern banking practice. Make sure you understand it deeply. Let's bring it all together. RAROC, or risk-adjusted return on capital, is a capital efficiency matrix that tells banks management whether a loan portfolio, customer, or business unit is generating sufficient return for the amount of risk capital tied. It's central to pricing, ensuring you charge enough to compensate for risk. It's central to portfolio optimization, that's deciding whether to deploy scarce capital. It's central to strategic resource allocation, determining which business deserves growth and which should be scaled back. And it is central to performance management, evaluating managers and business units on a risk-adjusted basis, not just on nominal profit. RARUC is not just a formula you memorize for the exam, it's a decision-making philosophy that aligns risk, return, and capital across the entire banking organization. Master this concept, understand its strengths and limitations, and you will have a powerful tool for both the FRM exam and your career and financial risk management. Thank you for your attention, and please do not forget to subscribe and also solve the link below the practice questions for this chapter. Thank you.